Hi, and thank you for joining us for today's webinar on investment philosophy. Just a little quote for you from John Kenneth Galbraith. Get a little humor there. Chief among the academic theories that drive investing advice today are efficient market hypothesis, rational investor theory, modern portfolio theory, efficient frontier, strategic allocation, what we often call the pie charts. And all of these have in common that they talk about what ought to happen and how markets and investors ought to behave based on theoretical models and equations. So this chart represents the performance of two hypothetical investments. The top line is trending upward, but has experienced bigger wiggles along the way. Academics call these wiggles variances, and their statistical measurement is called standard deviation. In academic investing theory, risk is frequently measured by standard deviation. The higher the standard deviation of an investment, the higher the risk, and the lower the standard deviation, the lower the risk. Because downward trending line on this chart has a lower standard deviation, this academic definition would imply it's less risky, even though it's currently trending downward. And counterintuitively, by the same definition, the top line might be considered more risky and presumably less desirable, even though it's currently trending upward. The equating of investment risk with standard deviation, seemingly at odds with the common sense perception of risk is simply the chance of losing money, has nonetheless been a major factor in the creation of millions of pie charts, the ones that have guided many investors for years.